Hello, my name is Joseph Beige. I'm a real estate attorney here on Long Island, and I want to welcome you to today's program. For our returning viewers, thanks for tuning in as always. And if you're new, let me explain a little bit about what we do. What we do on this program is very simple. We discuss various topics that would be of interest to you, the Long Island real estate consumer. And the goal is very simple. The idea is to help educate you so you can make better, more informed decisions on your next real estate transaction. Now, a lot of what we talk about sometimes is more specific. It covers just a buyer or a seller or a renter or so forth. Other topics that we discuss, such as today, cover everybody. And whether you're buying your first real estate property or your home or investment, or whether you've been a homeowner for the last 30 years, everybody has something in common: residential, commercial, renter, owner. That's insurance. You have to have it. It's either required by your lender or your landlord, or just good financial common sense. To get a better idea about how to determine your best course of action when it comes to insurance, I have help. Today I have Christine McDonough of Epic Insurance with me, and we're going to go over it. Christine, thank you so much for being here today.
Good morning, Joe.
Christine, before we talk about insurance and get into some of the more specific areas, just how did you get involved in the insurance industry?
So, unfortunately, most people don't grow up saying they want to be an insurance broker. People kind of tumble upon it, either through family or through just chance. I was about 17 years old when I started in the business. I was still in high school, and I saw a part-time sign on an insurance office, had to do a 5-hour test for my driver's license, filled out the application, and have been doing this ever since.
I'm not going to ask you how many years
Yeah, please don't.
And now you're currently with Epic Insurance Brokers. Can you give us a little insight about Epic?
So we were acquired from Epic Insurance Agency approximately 2 years ago. Like every other industry, it is becoming where smaller companies are being acquired by bigger companies and just growing their revenue. Same thing applies with Epic. This is our second acquisition in 5 years. I started with Gunderman & Gunderman Insurance Agency, have been with them for the past 15 years. And as we have been acquired, our roles have changed a little bit inside the agency, but basically I've been a producer with the agency for the past 15 years now.
Now, just to use the term producer, for people who are not familiar with the insurance industry or don't work with it like I do in real estate, when somebody says they're a producer, what does that mean?
So I basically assist people in helping them purchase the insurance that they need. As everything else happens in life, as you get older or your situation changes, you grow your family or what have you, your insurance needs change as well. Anything from life insurance to homeowners insurance to health insurance. The agency I work for is a full agency, so we handle all forms of insurance.
When people talk about homeowners insurance, what does that actually cover?
So homeowners policies cover named perils. Named perils are things like hurricane, lightning, water damage, fire, windstorm, which is hurricane, name perils, and depending on the type of policy you have, either those name perils may be all risk coverage if you are insured with a company like Chubb or AIG, or if you're with a middle market company, it could have some exclusions that a high net worth company would not include on their policies. So
now, you used two terms there, and I'm going to ask you to define those.
Sure.
Okay, and one was all risk and then exclusions. So when you say all risk, because again, as a consumer, somebody who, as a layperson, I would say all risk, that means I'm covered for everything. Is that true?
Well, no, not exactly. Like, for instance, whether you're in a high net worth carrier or a middle market carrier, the one thing that is never, ever covered under a homeowner's policy is flood coverage. And when I say flood coverage, I mean an overbody of water. Not if you have a hose that breaks off your washing machine and causes a flood. That would be covered under an HO3 policy, which is a special form. So unfortunately, there are so many different products in a homeowner structure. You could have a dwelling fire policy for a rental situation. You can have an HO3 for a regular home, or you can have an HO5, which is considered an all-risk policy. all risk policies cover items that, say, wouldn't be covered per se in a named peril policy only. So you have an Oriental rug and you spill bleach on it. On an all risk policy, that would be covered. On an HO3 policy, it may not be covered unless you have that Oriental rug scheduled or some sort of special coverage on that particular item.
Gotcha. So the all risk is a little more encompassing, including almost in that regards what it sounds like, all risks, including something that the homeowner may do accidentally.
Correct.
Where the other type of policy that you're talking to is really about an external force, weather conditions, quote unquote act of God, something breaks, something of that nature.
Exactly.
What are the types of things that are typically not covered on a homeowner's policy that homeowners think they wouldn't be covered for?
So the first thing and the foremost is flood coverage. Nationwide flood is never, ever covered under a homeowner's policy, no matter what kind of policy you have. Now, that being said, again, with the high net worth carriers, they sometimes will cover in excess over the national flood coverage that is run by the government. So the FEMA program, no matter what carrier you go to for flood coverage, it's a separate policy. It's never included on the homeowner's policy. A lot of people assume that flood coverage is covered. Things such as seepage, that's never covered, and it wouldn't even be covered under a flood policy. So if you have a crack in your foundation and your basement floods out from water entering in, you can't even buy coverage for that. So as much as a homeowner's policy that is there to protect your risk, to protect your financial asset, in the event of a loss, not every single claim will be covered under a homeowner's loss.
I think a lot of homeowners, myself included, tends to think that insurance is a way of mitigating 100% of the risk, and it really isn't. What you're doing is you're mitigating a substantial portion of the financial risk of your, typically your largest asset, your home, but it's not perfect, which means you have to still pay attention to maintenance, pay attention to things, and potentially budget for a repair that may not be completely covered.
Correct. And depending on the state you live in, Joe, there are a lot of issues with states like California and states like Florida being wind coverage, California being just about every weather element you can have. So there are policies that will exclude certain types of coverages depending on the demographic you're in. There are other things like earth movement that's never covered under a homeowner's policy, no matter where you live. Earth movement and earthquake can be two different things. So sometimes people will sustain losses like their porches start sinking in or their home starts sinking into the ground, so to speak. And a lot of that has to do with earth movement. And like I said, you can't even buy coverage back for things like that. First of all, if you could, the premiums in itself are very, very expensive, especially here on Long Island. If you started including every scenario where a loss would be covered, the insurance would be unattainable as far as pricing.
Now, just staying with floods, since you did say that floods are not covered under a general policy, that you need a separate flood policy. Obviously, certainly after Hurricane Sandy, there was a lot going on where certain carriers weren't even going to touch anything on the water. And homeowners that are on the water or close to the water are probably very familiar with floods. But Long Island's unique in the sense that you can be inland, nowhere near the water, and still be in a flood area and not necessarily know it. How would that conversation go between an insurance company and a consumer to find out, should I have flood insurance when it doesn't seem logical? I'm not on the water. I don't have a canal with a bay to my back.
Good question. So generally, I would say in the starting process when you're looking at a home, if you're just purchasing a home, the first thing is to ask your realtor. Do you know if this home is in a flood zone or not? And if it is, does the current owner have flood coverage or an elevation certificate to show that the home may be above elevation, which is determined again by FEMA. So you have a lot of these flood mappings, and because of Sandy, a lot of things were rezoned. Something that like Breezy Point. Breezy Point was never considered a flood area until after Sandy. And then they changed the flood zone. So if you've been in your home 15, 20 years, it's always good to check with your current insurance agent to see if that has changed. Because like I said, in specific areas where it was never a flood zone before, especially in the 5 boroughs, now has since changed.
Yeah, because after Sandy, my house, which is not near the water, became in a wind zone.
Correct.
And I did see a premium increase. And interestingly, we had a home inspector on the last episode, and we discussed getting a windstorm inspection to be able to maybe lower my premium. Now, let's step back, and we've got a typical new home buyer. They're going crazy. They're trying to make their mortgage company happy, their lender. They've got attorneys, everybody going crazy. And all they want to do is get into their new home and settle down. They're getting ready to close, and now they've got to get their homeowner's policy. What's the type of conversation that they should have, and what's going to be required from them by the insurance company?
Okay, so if they're purchasing, if it's in their first home and they're going to have a mortgage on this particular location, at the time of closing, prior to the closing, they would need to present the attorneys and the mortgage processor with a evidence of insurance along with a 1-year paid receipt. It shows the bank that you have at least 1 year's worth of insurance and that it's been paid in full, that if something should happen to the house in the first year, the mortgage is going to collect what their financial worth is with the home itself. So a couple of things. The first conversation they should be having if they're looking for a new insurance broker, it's important that whatever carrier they decide to secure homeowners coverage with has a good rating. And AM Best is the rating of insurance companies like Moody's is for the stock market. So I generally will say do not secure coverage with anything less than an A-rated company. You don't want to be insured with a carrier who has no rating, because that means that they don't have claims experience. Could be the reinsurers, they don't have enough reinsurers backing them. Could be that they just came out on the market just to take up market share. So, which a lot of insurance companies will do. They'll come out on the market as a new carrier. They'll price everything lower than everyone else, get the market share, and in the next 2 years, bring their rates up to everybody else. So there's a lot to go into buying insurance. Here on Long Island, if you have a package policy, you have more choices between carriers to choose from. A lot of companies that deal with Long Island and New York State will not write a monoline homeowners policy. And if they do, their premiums tend to be more expensive.
Sure. Now, does insurance companies typically require an inspection prior to securing coverage?
So they don't, because they'll do their own inspection. Generally, your mortgage company will require an inspection. And if you're paying cash for a home, then no inspection is required at all. That doesn't mean that you shouldn't get an inspection done prior, even if you're paying cash.
Gotcha.
Especially depending on how old the home is itself. So what'll happen is you'll secure coverage with a carrier, and generally within the first 2 to 3 weeks, they'll come out and do an inspection of location. The inspection purposes are to make sure that the home is not over or underinsured at the dwelling coverage limit, not at the sale price. They'll also check for hazards to make sure that the home is stable. A lot of times they'll check on pools to make sure there's fences and locks and things of that nature. So they will do an inspection, and they'll come back to the insurance broker and say, okay, well, this is what we found during our inspection, and this is what you need to do, or everything is fine. And then you go back to the customer and kind of discuss it with them at that point.
Interesting. I wanted to now start to move into the different types of policies. You have dwelling, guaranteed replacement, things of this nature, and some of these. When you say dwelling policy, what is that? What do you mean by dwelling policy?
So a dwelling policy is basically for a homeowner who rents their location out to someone else. Even if they are renting it to a family member, depending on that family member's age, they still would need a renter's policy. So hypothetically, your child is now ready to move out on their own and you want to buy them a little location. If that child is over the age, I believe, 24, they then have to get renter's coverage for their own liability and their own personal contents. Their parents' policy will not cover their particular items after the age of 24. If you're renting it just to a stranger and you have an annual rent, again, they would be responsible for their own coverage as far as their personal contents and their liability coverage. And the owner then gets a dwelling fire policy that covers their liability as well as the dwelling itself.
Okay. So, and when we say liability, we're talking about liability to third party. Somebody trips on
That's correct.
That's the liability. And the dwelling then in that scenario would be covering the structure.
Correct.
Not necessarily the couch or anything else.
Or the contents. Correct.
Contents, correct. Okay. Now, when a homeowner is going to be occupying their own property, and I know typically my clients get guaranteed replacement, but guaranteed replacement, again, it's one of those terms. It sounds like I get my house back exactly the way it was, and it may not be. So let's talk about that a little bit. What is a guaranteed replacement for the sake of people who've never heard the term?
So the reason the guaranteed replacement cost means the company that you are with, in the event that you have a total loss, will rebuild your home from the foundation up for whatever it costs to rebuild. That's guaranteed replacement cost coverage. So hypothetically, I have a home that's worth $1 million. And I insure it today, and the company doesn't get out there for another 3 weeks to do the inspection. I do the insurance for $1 million in coverage. The insured has a loss, a fire loss, and now it costs $1.5 to $2 million to replace the home. If the insured has guaranteed replacement cost, and again, usually only your high net worth carriers offer 100% guaranteed replacement cost coverage. The carrier will replace the house for whatever it costs to replace. Most of your middle market companies, your Travelers, your Merchants, your Hartfords, they will give you 25% guaranteed replacement cost coverage. So if you have a house that's $500,000 in coverage and they're including 25% guaranteed replacement cost, it's above that 25% over the $500,000. We live in a state that has inflation guard. So each year your coverage will increase anyway with the cost of inflation. That 25% then goes on top of whatever that current dwelling coverage limit is.
Gotcha. So simple math. You have for every $100 of insurance, you've got an extra 25% of a fudge factor to cover the increase, plus you have inflation.
Correct.
Okay.
See, there's a lot that goes into, I think the general consumer doesn't understand that, first of all, when you're purchasing a home, insurance is never going to be based on the sale of the house. The market is too fluctuating. You could have a good year, 1 year with the market where homes are skyrocketing, and then you could have several bad years. So insurance is there just for the purpose of rebuilding your home from the foundation up. More times than not, especially when you saw during COVID, people putting on their homes up for sale and say getting $15,000, $20,000, $30,000 above asking price just to sell their home and kind of take flight to different state or what have you. The insurance is never going to fluctuate like that. When you have a loss, not only do you have to then rebuild the house, but you could be talking about demolition, architect reports, zones that have changed over the years if your house was built, say, in the 1950s. So all of that goes into the replacement cost of a dwelling. It's not just rebuilding the home. If you have a partial fire and need to demolish the rest of the house, that could go in excess of $40,000, $50,000, $60,000, depending on how much of the home has to be demolished. So this all goes into the rebuilding cost of a home.
Now, again, this is an area where I think current homeowners, especially if you've been there a while, are really going to want to pay attention, because the longer somebody's in a house, they tend to do work. They redo kitchens, they redo things. And forget about the big extensions and so forth, but just internally. And again, insurance tends to be one of those that people have running on autopilot. The renewal comes in every year. And maybe if they're really vigilant, every 3 or 4 years, they tell their broker, put it out to, for bid and shop around, see if you can get me a better rate. But they really don't always communicate with the broker to say, oh, by the way, I put a big kitchen in. I redid I created a man cave or whatever, I put a pool in, things of the nature that have been dramatically increased the value, and that would also be more expensive to replace. So that 25% and inflation may sound very good in your first year, but if you don't communicate with your broker, and correct me if I'm wrong, 5 or 10 years down the road, you can leave yourself very vulnerable.
So one of the things we take pride in my particular agency, depending on the size of the account itself, is that we will either do an annual review with a client or we will do a 3-year review with a client. And one of the questions obviously is, have you made any major changes to your home? A couple of years back, well, actually about 10, 15 years ago, people were definitely using their homes sort of like an ATM machine. Then they were refinancing several times. They were taking their ranch homes and they were basically adding a second story, putting a pool, doing the backyard kitchen barbecue sets. And all of this obviously increases the dwelling coverage limit. So you are correct. A lot of people will stay with their homeowner carriers 15, 20 years and never have their agent kind of review their coverages. What's the point of paying a premium if at the time of a loss you're going to have to dig into your own pocket to pay out if you're not 100% insured to insurability?
And, again, correct me if I'm wrong, but generally the numbers, when you increase the amounts, your premium's not going up that dramatic. Certainly not when you see if you're looking at the potential loss.
Well, that's it. I mean, homeowners insurance on Long Island is not cheap. It's the days of paying $500 for a homeowner's policy are. That was when I was 17, Joe.
I don't even remember that.
So all I can tell you is, again, if you have a good agent or a broker, and they're able to kind of give you a package policy, that's kind of your best bet. Because then you get all the multi-policy credits in addition to an agent who's going to review your coverage.
Again, you just used a term that I probably should have asked you to define prior. What do you mean by package policy?
So a package policy would be, say, your home, your auto, and your umbrella with the same carrier. Generally, when you have your home and your auto together with the same company, they'll offer between a 10 and 15% discount. The umbrella is just by far the most important part of the insurance because it protects your financial assets in the event of a lawsuit. It is the cheapest of the insurance, but generally you can only get your umbrella policy if you have your home and your auto with the same carrier.
Now, real quick, you just mentioned umbrella policy. So let's just step aside a little bit and explain what is an umbrella policy and what does it cover?
So an umbrella policy is excess liability above your primary liability. Each insurance policy has a limit of liability on there. For instance, in New York State, for your auto policy, well, umbrellas are sold, first of all, in increments of $1 million. So in order to purchase $1 million umbrella policy, your auto liability limits have to be either $250,000, $500,000, or $500,000 single limit. So that in the event of a loss, if you choose the $1 million umbrella, you have $1.5 million in total liability over your autos. Same thing with your homeowners. Liability needs to be a little lower at $300,000. But again, you take the $300,000, you have the $1 million umbrella, you have $1.3 million of liability protection.
And again, when we're talking liability, it's being sued from a third party.
Correct. Car
accident, if you're at fault for, and unfortunately somebody sustains injuries. And at home, if somebody's on your property and you somehow, and you're sued and somehow found liable, it could be a worker, it could be somebody walking across your property, any one of a number of scenarios. It's a liability against a third party for injury. It's not an umbrella on top of your property damage, to your premises.
Correct. So it's in addition to. So umbrella policies are sold in increments, and depending on whatever your financial assets are, is how you should determine the limit of umbrella coverage that you need.
Right. Getting back to property insurance. We have numerous different types of property that you can have on Long Island. You can have single-family homes, multifamily homes, condominiums, townhouses, co-ops, pretty much almost every form you can have. Any specific differences the way you approach a client depending on the type of property that they have?
So it really depends on the value and their particular personal insurance needs. And I base that on the carriers that I'll go to. Being in the business for so long, I generally will know where a client fits depending on their insurance needs. Depending on the broker you have is depending on that type of service that, again, whether it's reviewing where you are now, reviewing potential future needs or what have you. It's really going to be based on the agent.
Now, just want to get into a couple little tips and tricks here. And one of my questions is going to be kind of general. But what is the number one defect that you see in current homeowners when they come to you and you're reviewing their insurance? And when I mean homeowners, whether it's a standalone home, condo, co-op, multifamily, but what is that one deficiency that they seem to have?
So the biggest thing is being underinsured. I see it a lot of times in situations with condominiums. Now, a condo is different than a home because with a condo, you only need insurance for the interior of your unit. There are always an association policy associated with condos and co-ops. Unfortunately, those policies will give for basic coverage for the interior of a condominium unit. You go to Manhattan and you look at some of these interior of the condos, it could be 1.5 up to 3, 4, 5 million to replace some of the interiors of these particular condos. I think people will generally believe a broker versus doing some of the research themselves to see what they actually are responsible for. For instance, you could have a condo in Florida where you're responsible for the interior windows, and that's not usually a thing that's included. But because they're hurricane glass and Florida is susceptible to hurricanes, they may, in their bylaws, say, you know what, Joe, you're responsible for the interior glass. So you have to kind of know a little bit about insurance and not just, you don't want to just rely on what a broker is telling you.
It's interesting because I know people who shop for car insurance have I've also done personal injury litigation, and clients there would tend to shop for the cheapest and not necessarily do the apples to apples comparison on the coverage and find that for, $100 cheaper premium, they gave up coverage for underinsured, coverage or for an uninsured motorist that hit them and so forth. So especially as you said, that's interesting. So condos, and I would tend to agree with that, since everybody thinks that the condo insurance takes care of building the structure,
right,
they then tend to not worry too much about the inside and forget that, guess what? That kitchen you redid, that bedroom that you redid, that bathroom that you did in complete marble and so forth, that's on you. Right. And if you shop by price without doing a comparison of the actual coverage, you can then be, again, you become the insurer yourself.
Exactly.
You become self-insured.
Exactly. And that's the problem is that if you're taking, remember that homes and condos and things of that nature, when you're talking about insurance, a lot of times the replacement cost is based on the square footage of the unit, plus the customability on the interior, or in a home situation, exterior and interior.
Right.
So all of these things obviously drive the cost up, depending on the customability of the location itself. But again, I've seen in the past where someone should be covered for $500,000 for additions and alterations and has $10,000 in coverage on their policy. And yes, they're only paying $400 a year, but at the time of a loss, that $400 is really not doing anything for them as far as the coverage.
And again, as we said, one of the best ways to look at it is that whatever's not being covered by your insurance carrier is being covered by you.
Exactly.
You're self-insured at that point.
Exactly.
And you got to decide about how much you're willing to do.
And especially even with the umbrella policies, there are so many people who do not carry an umbrella. You have a youthful driver at home who's starting to drive, or you have a couple of rental properties. That umbrella generally for 2 cars in one house maybe costs $500 a year for the first $1 million. There's no reason that anybody who owns a home or car in New York State they definitely should have an umbrella policy.
Interesting. You have a lot of clients who come to you, especially first-time home buyers. What is the one thing that you wish they knew when they were going to sit down with you that they already had set in their mind, or what question they had, or what piece of information they had for you to make the process faster and easier?
I think the one thing that both realtors do not give up information, your Zillows and things of that nature, is the square footage of your home. It is, again, when you're trying to figure out how much someone should be insured for, it primarily goes based on the square footage and the customability of the house. And also to remember that just because you buy a house for one purchase does not mean that the insurance is not going to be higher than the actual purchase price, depending on the type of market we're in,
right?
Given the situation.
Let's go from a first-time home buyer to a current homeowner. And I think we kind of hit on this already, so I think I know the answer. But somebody who's been in their house 10, 15, 20 years, what is the one piece of advice that you would give them in terms of their homeowner's insurance?
Well, to make sure that they're checking periodically. Again, I've seen it all too many times. People have been with the same insurance broker, same insurance company, 5, 10, 15 years, and have never reviewed their coverages. They've made some substantial improvements to their home and things of that nature, and it just has not been brought up to date. Question your broker. You know what I mean? Definitely ask questions.
Now, hopefully, anybody has questions, we're going to, obviously, they'll direct them to you. But if somebody is shopping around and looking maybe for different brokers, they've been with one and they're not too happy, or their broker may have retired or left the state and what have you, and they're looking for somebody else, what's a couple of questions that a consumer should ask to determine whether or not they're with the right broker?
I would definitely find out what carriers they represent, and if they represent them directly. There's too many times that you'll go to, say it's a company I represent, say it's Chubb Insurance. I go direct to Chubb. I don't have to go to a middleman or a wholesaler. So it would be the consumer going to a broker and the broker going to a wholesaler to secure coverage. And in the event of a claim, that having that third party involved can slow up the process. So having an agent that directly deals with that carrier is important. It's also, unfortunately, we are a price-driven society. And like you stated before, it's not always about the price, because you could be with a carrier that's taking up market share, that's only been in business for a few years. And if there's a catastrophic loss like a hurricane, they may not be able to service or have enough of the backing with the reinsurers to actually pay out those claims properly.
Now, just real fast, because you brought something up about the ability for them to pay. When I deal with title insurance, the only thing I insist on, because all the reinsurers, all the underinsurers are top notch, but I always insist that it's a New York State licensed insurer.
Correct.
Because being New York State licensed insurance, basically New York State will guarantee that if they're insolvent, your claim still gets paid. There's the same thing, and yet I'm going to assume you're going to tell me that there's the same thing in your industry as well, that there are carriers that are not licensed in the state but are still having policies sold.
That's correct. You know, whether it's a Lloyd's, a London policy, or a Lexington, a Scottsdale, those are all non-admitted carriers that are not recognized by the insurance department for insolvency or for insurance claims in the event of catastrophic losses. That being said, there is a need for that depending on the situation. Like, for instance, with Sandy, let's take the block of Lindenhurst. There were a lot of homes that were not allowed to be rebuilt after Sandy because they've already sustained 2 or 3 losses previously in, say, a 10, 15-year span. If the houses are allowed to be rebuilt there, most of your direct carriers will not touch them with a 10-foot pole. So whether you're talking about homes on Dune Road or you're talking about homes that are in Florida that are right on the coast, a lot of times your admitted markets will decline to write those particular locations, and then you have to go to a carrier that may be considered non-admitted, but still will have that insurance protection in the event of a loss.
Interesting.
Unless you can self-insure yourself.
Right.
Right. So if you have that kind of money and you can buy a $10 million house on Dune Road, then maybe you have that ability to self-insure.
Or you may, at that point, not be take the gamble that the not admitted carrier from out of state will be solvent when you need them and at least mitigate your self-insured
Exactly.
risk.
And the most important thing, again, is the liability protection. You know, people that have considered high net worth people, they may not necessarily, for instance, if I have a high net worth client and they purchased a home in Florida, they may choose not to purchase wind coverage. A lot of policies can exclude it for a lot less cost. When you're talking about wind premiums that are in excess of what the homeowner's premium would normally be by 3, 4, 5 times the amount, depending on the situation and if the house is totally wind mitigated, you may opt not to have that coverage.
Right.
You may not have a mortgage, that the mortgage, it's not going to make a difference. So it really does depend on the situation. But yes, a company like Lloyd's is the largest non-admitted carrier in the world. I mean, they've been, up with AIG and Chubb, the largest in the entire world, because you have company like Lloyd's that insure your sports people, your athletes, that the backing is there, but you always want to choose an admitted carrier first over a non-admitted carrier. Yeah, absolutely.
Great.
Absolutely.
Great. Christine, we're running out of time here, and there's a whole nother section we didn't even get to. We didn't even touch on renters policies. We mentioned them briefly. Forget about business and for commercial landlords and for commercial tenants. So hopefully I didn't bore you too much.
No,
Hopefully
not
this
at
wasn't
all.
too
Not
much
at
of an
all.
ordeal and you'll come back.
I hope I answered some questions that people, have that they don't think to ask or.
No, you did. You did a great job. I want to thank you.
No problem.
As always, Christine's information is going to be at the end of the video, her contact at Epic Insurance Brokers. I want to thank you for watching, as always. Hopefully you learned a little more about the insurance industry. You can look at your own policies, whether you're a new homeowner or a existing homeowner. Look at them a little more critically and be able to ask more detailed questions of your broker. Make sure you have the coverage that you need, because again, if you're not being covered by the policy, if the policy has an exclusion or has a gap, you are insuring yourself. Okay, you've now become the self-insurer. And given the rise in the construction cost on Long Island, and you go into Home Depot, you can now see what a piece of plywood is going for. You really want to make sure somebody else is taking on that risk, not yourself. As always, thank you for watching. My name is Joseph Beige. I'm a Long Island real estate attorney. And if I can have any questions for me, my contact will be at the end of the video. Thank you.